All right. So maybe Anshul might take a minute to come back. In the meantime, we'd like to start the conversation. So this is the panel that I was looking out for and sort of wanted to discuss. So this is Mrinal. I think this was the first time you're joining, and we are also organizing this conclave for the first time. And see, the objective is very clear that we want to, build a case, very very strong case for alternate investing and portfolio management services in India. As you all know that globally alternate investing is exploding big time, in the sense that the total asset size has reached to almost $12 trillion, vis-a-vis the total market cap of the entire world, which is maybe closer to $90 trillion as we speak. And there is good amount of passivization happening, in the sense that in mutual funds, some of the mutual funds globally are not able to generate alpha, and because they hold more than 70-80 stocks, and therefore a lot of investors are either moving out to passive funds or index funds, and then building the alternate investments, a kitty separately. So we want to talk about that. So let me come to Kshitiz first. So Kshitiz, before I go to Mrinal, my first question is, there was a time that, see, mutual fund to sahi hai. Mutual fund has now almost 24 years of track record, and you are there in the industry for over 2 decades now and witnessing the growth of mutual fund industry. But there was a time when everybody said that, mutual fund is 100% and you're done. Your portfolio is done. Now, what we're witnessing is, on the other side, a lot of investors taking interest towards portfolio management services and alternate investing funds, and trying to enhance their overall returns and the experience both. So what is your take on that? Over to you, Kshitiz.
So thank you, Vikas. Hello, Mrinal. Good to be on the same platform. I've been hearing you, quite oftenly. And congratulations, Vikas, for organizing this successful event. I've been hearing, all the learned speakers today, and the way it's been organized, really very impressive. Congratulations. Coming back to, yes, mutual fund sahi hai. Mutual fund sahi tha aur rahega. So mutual fund is one of the asset class, you can say one of the investment platforms, which is good for people across various salary bands or income bands. So that's a investment vehicle which has actually gained up really well. But we have a long way to go in mutual fund also. But yes, when you want to diversify your portfolio, and when you want to have that extra delta on your portfolio, or let's say you want to have you want to participate in various asset classes where you don't want to buy one piece of land, or let's say one private equity company, but you want a diversification on that tool also, then you need PMS and alternate investments. So it has its own role play. So these are all investment vehicles. Idea is to create wealth, whether it's mutual fund, PMS, or alternate investments. And in my journey in last 18-20 years, what we have spent in this industry, I've seen this entire piece evolving. So there's a set of client which can take all three asset classes. There's a set of client which can just stay put with PMS and mutual fund, and there's a set of client which can just be staying with on the mutual fund side only. But yes, overall what we have discovered, in a single PMS also, you have 28-30 stocks, depending on different strategies. Some really have 15-16 stocks. When you go with little over more than 20-22 stocks, most part of unsystematic risk has been taken care. So and that's how you diversify. So somebody asked me who should have a PMS portfolio. I say anybody who has a portfolio which is more than 2 CR or 2.5 CR should have one PMS in the portfolio for sure. Because one, it gives you advantage of your personalized holdings of stocks. Second, it gives you advantage of managing this portfolio by an experienced guy who has a team of his research, and working on that research team, they come out with ideas. Now, depending on individual, what his preferences. So I'll say that retail client which are having portfolio between 50 lakh to 1 CR can stick to mutual fund route. But there are many big clients who are very happy with the mutual fund route. But yes, when you want to have that little bit of concentrated play, although there are focus funds in mutual fund, but yes, where you see that you want to create that extra delta over mutual fund. Second, where you want to participate in various other asset classes. Tomorrow, let's say some clients say that I have a real estate portfolio, but I see that I want to have a real estate participation through a fund route. Then you have a PMS, or let's say alternate investment part. You say you want some angel investing ideas, but you are not pretty sure about whether you should put money in these ideas given by someone. Then you have your private equity funds which are there. So, then you need all these various platforms. So for me, mutual fund is a very good platform. But yes, PMS is capable of generating 2-3% extra is that from mutual fund if managed properly. At the same time, alternate investment gives you opportunity to diversify your portfolio across asset classes, and you diversify your risk also. Rather than just buying one piece of land in a real estate private equity fund, you take 10, 12 various different pieces of land. In a private equity fund, you take various 10, 12 emerging companies which are going to come out with their IPOs. So you diversify the risk. So there is a segment which gets catered by all these three product line. But yes, mix of all these three investment vehicle is good for a HNI from my side.
Sure, great, Kshitiz, great insight. So now going to Mrinal. Mrinal, you spend good amount of time in the mutual fund industry, and now move to InCred Asset Management, trying to build up the complete alternate investing, portfolios and portfolio management services. So, what's your sense that the topic which is there is that how important it is to allocate money when you are participating in capital markets? How important these two instruments are, which is AIF and PMS. Over to you.
So thanks Vikas for getting us over, and congratulations for the great lineup that you've done. So it's a very interesting question, Vikas. See, both if you call the alternates, which is the PMS and the AIF or the mutual fund, they are outcome of a regulatory classification, and I think that's a very logical classification. By that I mean, if you look at the larger landscape in our economy, we have had very high saving rates all along, but then most part of that savings were getting channelized into either fixed income instruments like an FD or a post office scheme or an LIC of some kind, or gold or property. So I think most Indian households were missing participation into the economic growth of the economy, which was the equity markets, public equity markets. So somewhere UTI tried doing that for a long period of time, and then the private mutual funds mid-90s came in. So they largely remain. I think the whole genesis of mutual funds is about creating a platform or vehicle to give small savers, in particular, an opportunity to participate in the market. Although SEBI classifies small savers in various ways, but let's just say that anybody who has less than 50 lakhs to deploy should consider mutual fund. Yes, it's not to say that large HNIs or ultra HNIs cannot do that, but then predominantly by a regulatory mindset, from a construct perspective, mutual funds are designed to participate in the equity market, so they become beta players. We obviously have various schemes which also chase alpha, but then it's a vehicle which kind of makes participation into the economic growth of the country, which the broader indices should reflect. So predominantly it's meant for investors or savers who want to have a beta play in their portfolio. And alternate investments, as the name suggests, they are basically providers of an alpha. Now, people, particularly, and that implies HNIs or ultra HNIs, people who have access to any kind of advice should potentially consider PMS or AIF, as the case may be. So that's a discussion that needs to be encouraged between the customer and the advisor. And based on that, they might be able to choose, select, and deploy in various ways into the right kind of PMS as well as AIF, as the case may be. It is also interesting that AIF has a variety of options. It has a fully listed option in Cat 3. We have long shorts also now. We have structured credits, VC, all those kind of things. That's regulatory classification again. But PMS largely works in the domain of listed equity. And I think in PMS, there is even more flexibility wherein you can choose to have very dedicated strategies to a particular client. That provision is there. Holdings are in the name of the client, as well as we can choose to have various different allocation at various different points. So there is far more customization based on client requirement and what the advisor feels is right for them in PMS and AIF, and that's the whole idea of having an alternate. I think it has been seen in every economy, and we will be no different. As we see incomes grow, as we see wealth increase in our economy, there will be need for more customized portfolios which PMS and AIF cater to and address in a far better way compared to, let's say, a mutual fund. That does not mean to say that mutual funds won't grow. They will significantly be larger in terms of asset size, no doubt about it. But there is still a lot of room for alternate products to actually make a mark in most investors and customers' portfolio, and that could be a significant, alpha provider to the overall scheme of things.
Right, great insights. I think, yeah, mutual funds will continue to grow. I mean, no denying on the fact that the participation in the, in Indian economy by these retail investors would continue to go up. But at the same time, some HNIs investor would look at some sort of, clear-cut ideas, and they would like to participate in that through, various instruments like portfolio management services. Now, coming to Kshitiz, as a house, you have both the distribution arm as well as your own PMS. Which is digital compounder, which is more of particular theme based, the PMS, which is growing with help of digital and technology both. Now, my question to you is, we've seen this happening and you spend almost 2 decades in the industry, Kshitiz, is that there are investors who come with some pre-mindset when they invest in PMSs that, they will be able to generate and outperform and beat the performance of everyone in a matter of a year or two, and then take the money back home, walk back to home. To what extent it is doable, and what would be your message to investors, especially when they are investing in PMSs? Because you run your own PMS, so therefore I'm asking you this question.
So, Vikas, when you ask me about many people that see that, PMS can be a money-making machine, or maybe this can give, much better than return than mutual fund. This is not the case. Look, it's an investment vehicle like mutual fund. Yes, it, as Mrinal pointed out, this can be customized. This is a direct holding of stocks which you can have, because in my journey, as you said, in various organizations, especially we were working together in Motilal Oswal. If you recall, India is predominantly a promoter-driven, holding organizations. Normally, you see 53-54% promoter holding, 26-27%. Now FI has reduced, but initially it was at 26-27%. Then you have 10-11% DI holding. So retail participation is 8-9% only. But surprisingly, in that 8-9% participation, you see most of the retail participation is not in good part of the stocks. You see, we have 33 lakh plus Vodafone shareholders, 30 lakh plus Yes Bank shareholders. So from where I'm coming is that when you manage portfolio of your own, things become really very, very, very diversified. You end up buying 60, 70, 80 stocks depending on what calls you're getting. PMS, when you come to portfolio manager who is a specialist of managing a stocks portfolio, and he tries to do a better job with others, then you have a professional management of the stock portfolio. At the same time, doesn't mean that because you were not able to generate return, he will generate return overnight. This will not happen. So any investment vehicle which you use to create wealth for yourself, you need to give time. There's a flexibility in PMS that there are no loads, exit loads. Like in AIF, there are loads. But PMS also requires time to deliver or perform. At the same time, it's a little more flexible when it comes to holding number of stocks or giving allocations, but it can be customized also. So people who think that, yes, I can give money to a portfolio manager, and let's say if they are on the right side of the cycle, let's say 2014 or 2020 for that matter, they can make some return and move out. So I'm saying it's good to talk about this in hindsight, but if you actually see, return can only be generated over a period of time. You are thinking that 100 has become 200 and I should move out. Maybe the capability of that 100 to become 1,000 is much more than what you're thinking right now. So if you don't need the money, then these investments are forever. You might change the portfolio manager tomorrow. Let's say you don't like Mrinal, or you don't like me, or you don't like any other portfolio manager. You can change that. But for you to actually create wealth for yourself, it has to be through equities or let's say real estate. These are the two expanding asset classes. Gold can be a good hedge. So platform you can decide. But yes, for a HNI or a super HNI, I think PMS is a good platform. And here I'm talking about HNI, which is having a portfolio of 1.5 to 2 crore. He can look at adding one portfolio and then he can keep on adding it. But at the same time, the beauty of PMS right now is like we do SIPs in a PMS. So you can subscribe to a PMS, and then you can have monthly flows also going in PMS. So you're not restricting yourself, your X becoming 2X or 4X or 6X in 10, 12 years time, but you can keep on adding on to it. So it can have advantage of compounding over a period of time with your set amount also. So I think it's a long gestation, but it's actually giving you better result the more longer you are staying in the game. So it will give you better return. Any PMS, old PMS offer, whether it's ASK or Enam or Moti, if you see the performance, when they show, maybe the last 3-4 years have not been really good for most of them. But if you see the long-term record, why it's been good? Because the compounding also plays over a period of time. So my sense is that thinking about that you can move out in 2 years or 3 years will not be a good idea. But yes, if you're here for long, whether it's mutual fund or PMS AIF, you have to give time for your wealth to compound. So that's the key.
Sure, sure. Great, Kshitiz. Yeah. So that is where the accident takes place. When you come with some pre-mindset that, you want to do something extraordinary, and when you see that is not getting through, and then start comparing your PMS performance with other instruments, and that is where you get disheartened, and, you decide to come out of it. And that's where the accident takes place. So it's very important. Now going to Mrinal. Now Mrinal, because you spend good amount of time on the mutual fund side, there is this perception, or I don't know if it is perception or it's reality, that because mutual funds keep getting money and they average it out, therefore at times they deliver more returns than PMS. So do you agree to that, or anything that you want to share?
Well, I've been in the mutual fund in an era when they were not getting money. I've seen the era where they were getting money. And so I've seen it all in terms of money flows, money going out post 2008 crash, money coming in, and all of that. So, well, see, monies or flows, I feel are overstated from what they can do to long-term returns. In the near term, they can definitely distort the market prices, but then the sheer size of the market is such now that it can't be sustained for too long. So the reality is that you can't run away from the fact that if you invest into businesses which are going to grow their earnings, and you are sensible about what price you buy those businesses at, you will make money. So that is not going to be significantly different between a mutual fund, PMS, or an AIF. So it largely becomes a skill game. And it is more about what is more suitable to the client risk profile in terms of both time horizon and what kind of risk he can onboard. So for example, if somebody is a business owner and he owns let's say a chemical business, so he actually does not want to deploy monies in a chemical business. He would like to put monies in the market, but X of chemicals. Now this is where a PMS comes into picture or an AIF comes into picture. We can obviously customize the investments which will have none of chemicals, but is already exposed in terms of his personal business to chemicals in a significant way. Or the case could be anything. I mean, most ultra HNIs are business owners of some sort. So it would be unfair to say that PMSs will definitely give higher return or mutual funds will give higher return. It says nothing like that. It is basically about the skill of the manager. And I have had a lot of international consultants engagements and a lot of endowments and pension kind of engagements. It primarily is about the person who's managing. That's the first criteria. And then you look at the processes. A mutual fund might as well do well as long as the person at the helm is fine. So I don't see a distinction in terms of just because it's a mutual fund or a PMS or an AIF. I would largely see distinction in terms of how the manager is going to deploy his skill, how is it going to manage the cycle and the risk, and what is the kind of risk that he's willing to onboard, and how is he going to manage them. So that's a very skill game, I would say. That's not largely the vehicle and platform will not determine or dictate returns. The skill will determine and dictate returns.
Well said. So you were saying essentially that instrument plays an important role, but to some extent, it's not the only parameter to look at. Ultimately, it boils down to the quality of the portfolio manager, the skills that they bring on the table, and the selection of stocks. Obviously, because market returns are function of how these stocks are doing. So wonderful. I think it was great interacting with all of you gentlemen. I think there were some technical issues, so Anshul could not manage to join. It was great interacting with you, and thank you so much for taking the time out from your busy schedule and talking to us. We wish you all the very best for your PMS and AIFs.
Thank
Thank you,
you.
Vikas. And once again,
Vikas.
congratulations for doing this so successfully. Thank you.
Bye,
Thank
Kshitiz.
you.
Bye.